Welcome to episode 3 of the ICT Mastery Blueprint. Today, the topic is liquidity. You need to understand liquidity so you can predict market moves, look for trade entries, find high probability trade setups, and understand where the market is likely to go. We're going to be discussing all of that in this video. If you haven't seen the previous 2 videos about fair value gaps and inversion fair value gaps, I would recommend you watch those first and then come and watch this next video. Without further ado, let's get started. So here's the title page for liquidity, and let's go to the second page. So what is liquidity? Liquidity in the market refers to areas in price or areas in the market where orders are likely to be filled due to a concentration of stop loss orders or pending orders. This area is referred to as resting money, also known as liquidity. So what does that mean? Basically means that there are levels inside the market, a certain level, let's say 21,000 for example, where there are a lot of stop losses, a concentration of stop loss orders or pending orders where liquidity is resting, meaning if price were to reach these levels, the liquidity pool would be engaged in. So let me give you an example. If we have liquidity or resting orders, so let's say stop losses or breakout trader buy orders resting at this level, right? You can see how the market draws to that level to engage in that liquidity pool and then use that to fill orders going short. And then same thing on the other side. If we have resting stop losses or sell orders for breakout traders resting at this specific level, we can see price engages that liquidity pool and then quickly reverses because it is distributing the orders that were accumulated or filled or paired at this specific liquidity pool to then send price higher. So how do you identify liquidity? Liquidity in the markets are resting above old highs and old lows. So any old high or old low that is put into the market has liquidity resting under it. Now, obviously, a higher time frame, high or low, may be considered as a larger liquidity pool. For example, a 1-minute high does not have the same resting liquidity as a daily high or low, right? So trading algorithms will refer back to these swing highs and lows as areas where orders are likely to be filled due to a concentration of stop loss orders or pending orders. So again, going back to this example, you can see orders are likely to be filled at this specific level, at this specific liquidity pool, because there are resting pending orders at that level, meaning the market needs to reach into there, and the trading algorithm will refer back to these swing highs and swing lows so they can fill orders due to the high concentration of stop loss orders, like we said. So what is a high in the market, or what is a swing high? A swing high or a high is a 3 candlestick pattern where the second candle has a high that is higher than the candle to the left and right, and a low or a swing low is a 3 candlestick pattern where the second candle has a low that is lower than the candle to the left and right. So what does that look like? You can see here this high and this high is identified as a swing high because there is a high on the second candle that is higher than the first and third. It kind of forms this V shape or this point. Same thing here. The high of this candle is higher than the high of the one to the left and one to the right. And I'll make my face cam a little smaller here. And then you can see here we have a low. The low is because there is a low lower than the one to the left and right. And same thing here, we have a low which is lower to the one to the left and right, meaning the 3 candlestick pattern forms this V shape where the second one kind of points out. That is a swing high or swing low. So between every single swing high and swing low, there is resting liquidity. It does not matter how many orders, does not matter if it's 1 or 1,000,000. It really does not matter. You just need to know that the algorithm will refer back to these highs and lows because it knows that there is liquidity resting at these levels. And then same thing on the opposite side, we have a low, a high, lower low, a higher high, in retrospect to this one and this one. So next page. Why is liquidity important? Why do you need to know about this? Why do we care? Blah, blah, blah. Liquidity is what fuels the market moves. There is no market moves. There is no filling of orders without liquidity. The algorithm runs on liquidity. It moves on liquidity. As liquidity is how large players can participate and execute orders. For example, if you were looking to place an order of 100,000 lot size, right? You simply cannot get executed on an order like that. There needs to be a engagement in a liquidity pool because inside that liquidity pool, Like we said, there's a high concentration of pending orders. So that's the only way these big players in the market can participate, is if they enter at these liquidity pools that are very highly concentrated. For example, a daily liquidity pool or a weekly liquidity pool, or some sort of relative equal high or lows where there's multiple liquidity pools stacked among the same area, which we'll talk about later. So buy side liquidity refers to resting buy orders found above highs, represents stop losses from short sellers, and buy orders from breakout traders. There's also sell side liquidity, which is resting sell orders found below lows, represents stop losses of long buyers, and sell orders from breakout traders. So what does that mean? It basically means at the specific high, we have stop losses from short sellers, and we have buy stops from people looking to take the breakout. So notice how the market engages this liquidity pool in order to fill and execute positions. That way it can move in toward the other direction, towards the sell side liquidity, where it can distribute its position to, right? Because over here we have unwilling, right? We have unwilling sellers, basically meaning that when we come up in here, we can engage this liquidity pool and fill shorts for the people who are looking to go short, right? And then over here we have unwilling buyers, meaning there are stop losses at this level. So as price comes down and engages this liquidity pool, we can sell our positions to these people who have stop losses resting there. And then the same thing on the other side, right? We engage this liquidity pool, we execute orders, smart money buys here, and price moves higher. And this is how the market moves on a grand scheme. And obviously this is a fractal idea, which we will talk about later in the example. So what is a liquidity sweep? A liquidity sweep is basically when price engages a liquidity pool, meaning it reaches towards a liquidity pool. So a liquidity sweep, also known as a stop hunt or a liquidity grab, occurs when price moves aggressively to take out stop losses or pending orders before reversing. So the purpose of a liquidity sweep is to reverse the market. The reason the liquidity sweep needs to occur before the reversal is because big players cannot participate in the market unless liquidity has been taken. Their orders can only be executed at these old highs and old lows in order to fill positions to then move the market. So it is a smart money concept used to anticipate market moves and visualize where large players are entering the market. So we can use liquidity sweeps to identify and anticipate large market moves, because we can understand and visualize where the large players might be entering the marketplace. So a buy side liquidity sweep is where we take out an old high. You can see the rejection from that old high, and we then move lower towards the sell side. A sell side liquidity sweep where we take out an old low. You can see the rejection from that old low, and the price reverses and then takes out the buy side. You can see this is a smart money reversal. So this is where smart money enters shorts. And over here, you can see this is also a smart money reversal where smart money enters longs. All right. Now we need to identify what is a liquidity run. So we know what a liquidity sweep is. After a liquidity sweep, we tend to have a run on liquidity. What is a run on liquidity? A liquidity run is a price run towards a liquidity pool, which is buy side or sell side liquidity, after a smart money reversal or liquidity sweep has occurred. So basically, after we take out liquidity, we tend to have a run on liquidity to then distribute those positions. So imagine you as a big player in the market and you are taking shorts right here, right? You then need to run on liquidity so you can take profits on those shorts. Where can you take profits on those shorts? Previous existing liquidity pools, right? So you're basically waiting for a liquidity sweep and then targeting an opposing liquidity pool, right? So one liquidity pool to the next. So that's basically what this is saying. When there is a liquidity sweep, you can look for a liquidity run towards a liquidity pool, meaning buy side or sell side liquidity. Now there's two types of liquidity runs in the marketplace. There is a low resistance liquidity run and a high resistance liquidity run. Exactly what you would expect to mean. A low resistance run is where price moves efficiently with minimal resistance towards the drawn liquidity. The drawn liquidity being that opposing liquidity pool. High resistance liquidity runs is when there is a liquidity run where price moves roughly and has large resistance towards the drawn liquidity. So the drawn liquidity is the same, but sometimes there are specific conditions that make it easy and efficient where the market can run towards a liquidity pool, or the market can be very rough, very choppy, very slow, deep retracements, and take a while to get towards that drawn liquidity, if at all. So for example, you can see in this left example, we have a very clean low resistance liquidity run. You can see price takes out a liquidity sweep. So we have a liquidity sweep, we get a retracement, and then the market pretty quickly runs on liquidity, which is lower, towards the draw on liquidity. And in this example, we have a very similar scenario, but you can see after the liquidity sweep, we then take we get another liquidity sweep of sell side, and then again of buy side, and we get this very slow and rough move towards that draw on liquidity. So this would be trading in the left as a low resistance liquidity condition, and this would be a high resistance liquidity condition. And we'll talk about in future episodes how you can predict low resistance versus high resistance liquidity runs, as this is where ideally you want to be trading, right? You want to be trading in this ideally, and you do not want to be trading in this. And a quick brief summary of how you can anticipate this is basically looking at the economic calendar, looking at time, looking at the previous day characteristics, the session, specific times of day, specific times of the week, stuff like that will all help you determine whether or not we're likely to be in low resistance or high resistance conditions. Now let's get to the charts and cover some examples of pretty much everything we talked about. Okay, so for our first example, very simple basic example, you can see here we have a liquidity sweep identified by price engaging this old high, which is the liquidity pool, buy side liquidity pool to be exact, and then you see we aggressively move lower, which basically takes out the opposing liquidity pool, right? So these lows over here, you can see we're all taken out, basically showing how a liquidity sweep can lead to a liquidity run. Then we have a retracement, and then we have a more aggressive liquidity run, right? So this is one very simple example where you can see we took out one liquidity identified by this rejection, and then we have a very quick low resistance liquidity run, and we take out another opposing liquidity pool. So one very simple example. Okay, now zooming into the chart, we can give you guys another example. So for example, here we have accumulation, and then we take out this low, which is again a liquidity pool. So we engage this liquidity pool and we immediately expand higher. This is our first signature of a smart money reversal. So you can see price takes out this liquidity, and then we start moving higher. We get displacement, we get a retracement, again taking out another pool of liquidity. So this low was taken out, we expand. This low was taken out and we expand. And where do we likely expand to? You're looking for opposing liquidity pools. So where are there opposing liquidity pools? Well, we have a liquidity pool right here. We have a liquidity pool right there. We have a liquidity pool right here. And then the final liquidity pool on this time frame and this specific interval would be up here. And we did not make it to the final target, but we definitely did have a pretty fast, quick, low resistance liquidity run towards these liquidity pools. So this is all identified as buy side liquidity, right? And a little quick trick what you can look at for is you want to be targeting liquidity pools in premium, right? So this one is not really in premium. So ideally, you want to be looking at the ones in premium because price likes to move from discount to premium. So a very quick, brief summary of discount and premium. When you mark out the range low to high, you can see where the market is cheap and expensive. And basically, if you're buying cheap, you want to sell expensive. So you're looking to buy cheap over here. And if you know, since we took out the sell side liquidity, you can look for buy side liquidity in premium markets. And we have a high right here. We also have a high right here. And you can see how the market very quickly, efficiently, does not really look rough at all, quickly get above these highs and take them out before reversing. Now, on the exact same side, if we just clear this chart quickly, you can see something very similar. After taking out this liquidity pool, right? So we take out buy side liquidity, and this is a liquidity sweep. Now this actually closes above on this time frame, but if you're going to zoom out to, let's say, another time frame, you can see it starts to wick at that high. If you zoom out some more, it really looks like a liquidity sweep now. So obviously the time frame you're looking at will affect whether or not it looks like we close above, but you can see here once we do close above, we start to reject and then quickly back close below. So what happens here? We take out buy side liquidity, and you can see we get that reversal confirmation, and we start targeting where? Sell side liquidity. Where's your sell side liquidity? Well, you have some right here, you have some right here, and if you actually zoom out, there are even larger liquidity pools that the market dumps towards, which is over here. And obviously, if you zoom out all the way, you'll see some more stuff that we were going towards. Okay, now that we got some basic examples out of the way, we're going to start pairing some of the concepts we've been teaching throughout the ICT Mastery Blueprint. So I want to take your attention to this specific low right here. Why is this specific low important? Because this specific low is resting inside of this bullish fair value gap. So if we can extend this bullish fair value gap, sorry, I would say buy side imbalance. So if we extend this buy side imbalance, we can see that there is a low right here resting inside of it. You can see the market trades down, takes out that liquidity pool. And now this is on the daily chart. So remember, these daily liquidity pools are very, very significant. And in fact, if you zoom out to the weekly, what you'd actually see is there's a weekly buy side imbalance here. And this is actually an old weekly low. So there's a very significant liquidity pool resting at this level. So you can see the algorithm refers back to this level. And from this level, given the characteristic of a Friday, you can see as price approaches that lunch time, going into PM session, we get a very sharp reaction. So for example, if we check the 50-minute time frame, you can see we engage that liquidity pool once, twice, 3 times, and then 4 times as we approach that lunch session. We get that full reversal, a very low resistance liquidity run. And again, what would you target after something like this is a signature of a smart money reversal? You would look for your liquidity pool. So you have buy side liquidity here, you have buy side liquidity here, and you have buy side liquidity here, which it just recently took out. And you can see it's already starting to fizzle out. Now the market won't simply just go up and down, taking buy side and sell side, but you always have to zoom in to the lower picture. So for example, here, it looks like we just simply rallied up one direction towards the buy side. But if you zoom into the time frame, you can see there are multiple liquidity sweeps intraday that lead to this move higher. So for example, if we are bullish, you can see right here, we took out this liquidity pool and then reversed. And if you keep zooming out, you'll see this characteristic over and over again. We took out this liquidity pool and then reversed. This is basically how the market moves on multiple time frames. We took out this liquidity pool and then expanded, we retraced, took out this liquidity pool, expanded, then retraced, and then we get some fair value gaps and so on and so forth. But hopefully you can start to see the idea how the market seeks liquidity, and then from that liquidity looks to distribute the positions that were bought or sold at that specific liquidity pool. Okay, so we're going to cover one more concept. We're going to talk about equal lows and equal highs. So as we talked about liquidity pools resting below old lows and old highs, you can see right here, we have almost kind of 2 stacked liquidity pools, which basically makes this a very high probability objective, or think about it as an even greater concentration of orders, so liquidity resting at this level, because there are liquidity here and liquidity here that are relatively close. So how could you potentially look to target something like this? Well, we already know smart money wants to position themselves in premium to target sell side. So what do we look for? We look for a raid on buy side. So if you look very closely here, we end up taking out this old high, which is buy side liquidity. And if you look very closely, there's actually relative equal highs here as well. So this liquidity pool is very in close proximity to this one, which you can see we engage both of these liquidity pools coming into 930. And what happens? You see we wick above these old highs, and then we get an inversion fair value gap, which we talked about in the previous videos. We get a bearish fair value gap right here, which also delivers lower. And you can see how this ends up giving us a reversal towards all that liquidity that was built up all the way down there. Now, obviously, there are some retracements along the way. So, for example, before continuing lower, notice how we take out liquidity higher. So every single significant price run lower usually occurs from a liquidity sweep higher. And every single significant price run higher usually occurs after a liquidity sweep lower. So every time we engage a liquidity pool, you can look for an opposing direction, even though it's in your relative bias, right? So obviously bias plays a big role here. And obviously this is a very, very large move in the market. So obviously it's going to take some time, but nonetheless, eventually we frame that run towards these equal lows based on the sweep of these equal highs. And you can see how the market retraces, and then come Monday afternoon session, we get a very nice low resistance liquidity run towards those equal lows. And then even then you can see we kind of get a pullback back into the range after. So hopefully this helps you guys understand liquidity and how the market moves. Obviously, this is the beginning of this series. So this is kind of a more basic introduction. We're going to cover more advanced concepts in liquidity going on. I really highly recommend you guys stay tuned with the playlist. Make sure you watch episode 1 and 2. Next episode will come out sometime next week. I appreciate all of you guys watching. Take care. Until next time. Peace.